The Manipulation of the Foreign Exchange Market by Wall Street Cabals by Marc Matura, Appalachian State University, December 3rd, 2015. I chose my topic because I was very interested in the inner workings of Wall Street groups, banks, and firms. I also thought that it was particularly impressive the sheer size of the market that they managed to manipulate. A multi-trillion-dollar market at the heat of just a few people in internet chat rooms just seemed really ludicrous, almost, just the thought of it. In order to make it clear how these groups on Wall Street manipulated the market, one must first understand how the foreign exchange market works. As you can see here, this is a typical foreign exchange chart. Along the bottom, you have the time of day of these trades, and on the right side, you see the value of the currency. Each small square of red or green indicates a gain or a loss in the value of the currency. Where people tend to get confused is how the real money is made. If you note on the right, it's very, very small values. If that was $1, it would be the fractions of the 35th cent of the second dollar. This, of course, is in contrast to the stock market, where the minimum entry is by purchasing one share of each stock, and those stocks could be anywhere from a few cents to hundreds of dollars each. This is quite different in the sense that rather than trading with a few shares in other companies, you would need to trade to make any profit. You would need to trade in the millions, billions even. Now, where people get confused also is they don't understand how anyone can make money in this. If you need millions upon billions of dollars to enter the market and make any money, how can anyone do it? So for most people, in order to get into the market, they would need to go through a foreign exchange broker. Now, the foreign exchange broker would set you up with leverage to enter the market. For example, if you went to a foreign exchange broker that had a 100-to-1 ratio, if you gave them $100, you would be able to use $10,000 on the foreign exchange market. Any money that you gain from the difference of your trades will be given to you, you'll earn it, and any money that you lose from your trades, if the value of your currency goes down, then they would take it out of the money that you gave them. So for example, let's say that you had $1 million in leverage money from your broker to use as you saw fit on the foreign exchange market. Let's say you bought $1 million worth of euros. Now, let's say after holding on to these euros for however long, maybe a day, a few hours, a week, that they are stronger against the dollar than when you originally bought in. Now let's say if the euro gains 5 euro cents in value against the dollar, when you trade back to dollars, you'll be getting an additional 5 euro cents worth of dollars for every dollar that you put in. Now these numbers are fairly simplified for the example, but you generally wouldn't see this type of profit on a daily basis unless, of course, you happen to be a Wall Street insider. Now that we have the basic understanding of the foreign exchange market, it's time to get down to how exactly these Wall Street traders managed to work with each other in such a way that it would change the value of entire currencies whenever they saw fit. Now, let's imagine a bowl of soup. The more you eat, the closer it gets to the bottom. Now, when you reach the very bottom of the bowl, and there's so little soup left that it's difficult for you to get out with your spoon, what would you do? Naturally, one would tilt their bowl a little bit in order to put the soup in a better position for you to pick it up. Now, this example is very similar to what we'll be discussing today, except in our situation, except that you can't possibly tilt the bowl yourself, and having anyone else help you tilt the bowl would be illegal. So how did the Wall Street traders apply this concept to the foreign exchange market? What they did was make these small circles of people in online chat rooms, aptly named the cartel, the mafia, the club of thieves, etc. And in these chat rooms, they would share the information of their clients' trades. For example, if they knew that one firm was going to be trading $1 million of the ruble against the New Zealand dollar, then they would let each other know so that when the trade happened and the prices fluctuated, the other people in the chat room would know exactly when and by how much so that they could adjust their trades or buy into the market accordingly. This enabled them to make billions of dollars off of transactions that should have been private. When first researching my topic, I wasn't sure exactly what this would be categorized under, but now it seems to me that it falls under the rather broader category of insider trading. It's worth noting that these groups were able to do this so easily because the foreign exchange market isn't nearly as regulated as, say, the stock market. Surprisingly enough, no market regulators had actually investigated this until Bloomberg News had reported it. Bloomberg had said that the currency dealers were colluding with each other to fix rates on the currencies that they were trading. This had gone on for at least a decade already, according to traders within the network. Bloomberg had only reported this in June of 2013. Imagine how much money that these people were making throughout the course of the time that this has been going on unchecked. After much investigation and probing over the course of around a year and a half, a group of investors who had been fairly ticked off about this sued the banks through a consolidated antitrust lawsuit that accused the lenders of colluding to manipulate foreign exchange prices. The litigation was filed in the United States District Court in Manhattan, and it was a merger of several lawsuits that had already been filed since November. My first scholarly source was the Northwestern University Law Review. In this, Kimberly D. Krawick portrayed a financial community divided on the topic of insider trading. On one hand, some people see it as an unfair practice that would exclude many people from the market, resulting in greater loss than benefit. However, others see it as a business practice that doesn't really harm anyone else and overall increases the efficiency of the market. One important note that she mentions at the beginning of this is that the current laws and regulations in place for insider trading aren't very effective in what they do. Her quote makes it seem as though it was very shoddily put together, calling it vague and ill-formed. This happened to be a recurring theme that I noticed while doing research among scholars on this topic. That it didn't really matter which side they were on, but it seemed as though both sides agreed that the current system is very nondescript and generally ineffective. Krawick goes on to mention that scholars have struggled with the insider trading problem for quite some time now. They've tried to resolve the issue by exploring solutions in fields like economics, morality, and sociology. Even though these have contributed quite a bit to the debate, nothing has really been able to resolve the problem. Krawick believes that this isn't so much a problem of insider trading itself, but rather the overarching nature of information sharing as a whole. Jonathan R. Macy, in the Hofstra Law Review, had a similar thought as Krawick. He believed that the current rules and regulations surrounding insider trading, specifically Rule 10b-5, are very ambiguous in nature and purpose. Rule 10b-5 is a stipulation which makes it illegal for corporate insiders to trade based on non-public information. Macy goes on to mention that the real concern behind insider trading is about the optimal allocation of information among parties, and the confusion surrounding the rule is a result of a failure to conceptualize the problem in contractual terms. A quote of his that stuck out to me the most was, "The small number of commentators who have suggested that insider trading prohibitions might be justified in certain contexts because such trading involves the theft or misappropriation of someone else's property have failed to recognize the extent to which the court is already doing precisely what they suggest." In my opinion, the answer lies somewhere in the middle. Firstly, I wholeheartedly agree with the current system being too vague. I concede that coming to a reasonable and effective solution for a topic with as many variables and possibilities as this is difficult, but I have a general concept that I think might be effective. This would require much looking over by economists to prove valid, however. I believe that maybe it would be more effective to only punish instances of insider trading which have a significant negative effect on the market at large, or a very significant effect on a few others, individuals. If insider trading could increase effectiveness overall and result in a more efficient market, then why restrict it?